Today we're going to talk about interest rates. My name is Corey Harter. I'm with Homes by Chris Harter in eXp Realty. Here we are at the end of February, beginning of March, and certainly we've seen a rise in mortgage rates in a volatile environment. I'm going to cover where we're at now. So let's get started right here. This is a statement from Sam Cater, Chief Economist from Freddie Mac. He made this earlier this month. He's saying that the economy lost momentum in January, leaving interest mortgage rates unchanged from last week and relatively flat for the third consecutive week. This stagnation reflects the economic impact of the Omicron variant of COVID-19, which we believe will subside in the coming months. As economic recovery continues growing into the spring and summer, mortgage rates are expected to resume their upward trajectory. In the meantime, recent data suggests that homebuyer demand continues to be elevated as supply remains low, driving higher home prices. This statement came out the day before the February jobs report, and certainly a positive jobs report hints to the Fed taking action in raising the Fed funds rate in March. Expect to see rates go up. We're at about 3.6% on the average 30-year fixed right now, recorded by Freddie Mac. But no doubt a volatile January leading into February that will probably see more rise in rates. And that's what we need to be prepared for. So if we look at this rise in rates, this slide here, we're at about 3.55%. This graphic goes back to the beginning of 2020, and we're starting to get back into that area. We're back in the area of where we started when the pandemic came on us in March of 2020. Now, just to put that into perspective, the Fed comes in and acts, that they influence. The Feds don't control mortgage rates, but they do influence the rates. They were down and now we're back up. Certainly a sign that we can all have hope, that the economy is improving, that we're getting through this, and that we're moving ahead. If you take a little bit larger look, if you go back at the beginning of 2018, which is what this graphic shows on the average 30-year fixed, and sort of make this line of 3.55%, you can see that where we sit there. Certainly we're higher back in 2018 and 19, started to come down, and certainly dropped to historic lows during the pandemic, and started to come back out of that. Now here's some perspective on that, again from Freddie Mac. As mortgage rates rise, we do expect some moderation in housing demand, causing home price growth to temper. However, the combination of a large number of entry-level home buyers facing a shortage of entry-level inventory of homes, we should keep the housing market competitive. In 2022, we expect purchase originations to grow from $1.9 trillion in 2021 to $2.1 trillion in 2022, while refinance activity is anticipated to decrease from $2.7 trillion in 2021 to $1.2 trillion in 22. Now, why is this important? You want to look at the two mortgage markets. You have the purchase market, you have the refinance market. The purchase market is forecasted to grow, refinance market forecasted to constrict. And that all makes sense, right? In a rising rate environment, everybody already had their chance to refinance. But most people refinance at a record low rate, and good for them as homeowners to be able to do that. But we're going to see that volume constrict. Why is this important right now? You're going to see headlines that talk about overall mortgage market constricting. You know, the hyper state of awareness, and when you're thinking about doing something, you start to recognize every little article and every headline that's out there. We do need to keep things in perspective. The purchase market is definitely going to grow. The refinance market is going to constrict. You know, if you take this rate of 3.55% and even go into 4%, which we'll probably see very soon, that's still a very, very favorable rate when you go back all the way to the 70s. This slide here shows the average 30-year fixed by decade. If you go to 3.55% or even 4%, still very, very favorable financing when you look historically. Between 2010 and 2020, we bounced around 3.5 to 5% was really the range of interest during that time. You see the average rate in 2010 of that decade, 4.9%. Very, very good financing. So higher and higher, but when you look at historically, we're still very, very good financing rates all across the homes across the country. So the last two slides are the country. So the last two slides are around interest rates in this market. Everyone is interested in where interest rates are going to go. Well, look, this is the 10-year Treasury yield. This is a look at back to the beginning of December, just 2 months ago. And what do we know? During that time, the rate on the 10-year Treasury yield has skyrocketed, knocking on the door right now, almost 2%. Why is this so important? Well, here's why it is important. For the last 50 years, the relationship between the mortgage rate and the 10-year Treasury yield has almost been symbiotic. Wherever the 10-year Treasury yield goes, there goes the 30-year fixed rate. The Fed rising rates does not control interest rates. It can only influence it. What we want to watch is the 10-year Treasury yield, because over the past 50 years, there's been a relationship between the 10-year Treasury and the 30-year fixed. So we started the year at about 3.1%, where we were at right now at 3.5%, and where we're going, probably around 4% or more. I'm not saying we're going to stop at 4. I don't have a crystal ball, but that's certainly the outlook. Now I'll end with this slide here. Mortgage rates hit their highest level since March 2020, leading to the slowest pace of refinance activity in over 2 years. I hope this information has been helpful to you. As usual, it's an ever-changing market. We don't have a crystal ball. All we can do is try to do our best to stay on top of it and be aware of the things that are going on as we buy, sell, rent, invest. So if you like what you heard today, please tap the like button below and share with someone you know who could benefit from this information. If you have additional questions, you can DM, email, or call. We would love to speak with you. Have a great day.